Hi everyone, I'm Jesse Walden. I'm on the team at Andreessen Horowitz, program managing crypto startup school. And prior I was a founder of Mediachain, a project in the space. And so today I'm going to talk about considerations that crypto startups need to think through with regard to fundraising and deal structure. And there's going to be a lot here that riffs on Brian's presentation. First off, what is startup financing all about? And this is not just crypto, this is just startup financing in general. It's all about converting financial capital into production capital. And what that means is financial capital is an investment of money used to hire people and to build products and services. And production capital is the value of those products and services once built. And so again, this is true of both crypto startups and traditional ones. But a key difference between crypto and traditional startups is that the production capital in crypto networks comes from a community of contributors, not only the core team. And that has some pretty big implications. So in my earlier talk in the program on progressive decentralization, you guys heard about the 3 sequential objectives for crypto startups. The first is to build a product people want. The second is to build a community around that product and hopefully one with some network effects. And the third is to give ownership to the community. And in that talk, I sort of stated that the first 2 objectives are the same for crypto projects and traditional startups. Both need to build a product that people want. They need to get users and hopefully build a community around it. But it's this third objective, giving ownership to the community, where crypto starts to diverge a little bit. By giving ownership to the community members have a strong incentive to participate in generating the production capital of a network. Bitcoin and Ethereum, for example, have both built very vibrant communities of miners that operate the network in exchange for Bitcoin and ETH, respectively. And this has obviously been a very effective way to bootstrap those networks. What's different about fundraising in crypto? So as you can see on the top here, traditional startups grow by raising funding through a series of financing rounds. This enables them to hire more people, to expand their products and services, and effectively transform financial capital into production capital, and ultimately revenues that drive investment returns. And crypto startups, being community-owned, follow a slightly different trajectory. So the early stages, again, they look similar. Build a product, build a community. But at the point you've done that, you start to move into community ownership and operation mode. And so how this plays out in fundraising could be that, a crypto startup raises financial capital in a seed or subsequent early rounds, hires a great team, builds a great product, builds a community around that product. And then once there's sufficient community involvement, starts to invite the community to participate in ownership and operation. And so what that means is that subsequent growth for a crypto startup, both in the form of financial and production capital, comes from the community itself, who has a direct economic incentive to ensure that growth of the network over time. Now, the fact that crypto startups aim for community ownership has further implications for deal structure. So let's get into that. How should crypto founders structure deals? Well, again, given that the early stages of a crypto startup tend to be pretty similar to a traditional one, at A16Z, we tend to think that the best instrument to fundraise is still equity in a company. And I know in Brian's talk, we talked about this exciting new membership model, and we think that has a lot of promise. But what's tested and true is equity in a company. And so first off, why is equity the choice instrument for startup fundraising in general? Well, it's because equity facilitates long-term alignment between the founders, the team, and investors. So, whatever the company ends up doing, whether it needs to pivot, investors are aligned for that long haul by owning equity in the company. And crucially, this means that there's no obligation for a crypto company to produce a token. And that just wasn't true for ICOs or token pre-sales that we saw in the earlier days in the space, where the promise very much was to deliver a token. And as we know now, committing to a token up front can be a distraction from finding the perfect way to achieve product market fit. So where flexibility is critical, especially in the earliest stages of a startup, equity is the best way to achieve that alignment and flexibility that founders need. But if the goal of a crypto startup is to produce a network that's owned and operated by a large community of users all over the world, then a token being natively digital is likely the best instrument to coordinate it once the team is ready, because it's a lot harder to do as a security, as you heard in Brian's talk. So when it comes to deal structure, it's critical to figure out what happens to tokens if and when the founding team builds a network that generates them. And so the way that we've structured many deals is as an equity purchase in a company, but one that comes with rights to tokens. So that is, if the team builds a product or network that produces a token, then the investors will receive some of those tokens in proportion to their ownership stake in the company. And just like equity aligns investors with founders in a company, this token right aligns investors with founders and teams if the company builds a decentralized network coordinated by a token. And again, the keystone here is that investors will receive their proportional share relative to what the founders and the core team receive at the time of distribution. Now remember, crypto networks are meant to be community owned and operated, so it can't be the case that founders and investors own all of the tokens. So what about them? Where does the community's ownership stake come in? Well, this brings up the question of dilution. So to understand dilution, let's go back to our slide on fundraising trajectories. In a traditional startup, early founders, employees, and investors are diluted as the company takes on subsequent rounds of financing. And what I mean by that is that as the company goes through these rounds of fundraising from seed to A to B to C, new shares in the company are actually created. They're inflated. And those new shares are sold to new investors. So this means the ownership percentages of founders, early team members, and early investors get smaller as subsequent rounds of financing are raised. So that's dilution, but why do teams and investors agree to that? Well, the reason is that more financial capital coming into the company allows the company to grow its production capital. So to expand its products and services, hire more people. And as the production capital grows, the pie gets bigger for everyone. So while the early team and investors may own less in percentage terms, their ownership stake can be more valuable. And that's why they agree to dilution. So the same logic holds for crypto networks. Crypto networks raise financial capital to build production capital in the form of a product or network that they plan to hopefully progressively decentralize. And by giving community members a stake in the network, early founders and investors have a new tool to fuel growth and network effects that grow the pie. So community members contribute to the ongoing operation and success, and so it follows that it's in the interest of early founders and investors to take on some dilution from the community in order to grow the size of the pie overall. So to make this more concrete, let's walk through a specific example. So here's a very simple example of a seed round. Let's say $1 million is invested in exchange for 20% of the equity in a company. And this values the company at $5 million. Now, let's say the company plans to launch a network, and the goal of this network is to be decentralized or community owned and operated. So an allocation to the community needs to be considered and decided upon. Now, just for illustration, let's say the core team decides that the community will receive 50% of all the tokens in this network, which leaves the company and investors with the other 50% of tokens. Well, deciding on that specific distribution is important because it has implications for the valuation of the network, and here's how. So remember that $1 million into the company gives investors 20% of equity in that company. And when the company goes on to build this network, the community will get 50% of its tokens and the investors will get the other 50%. So that means that the investors' pro rata or proportional share of the network is 10%. That's 50% of their 20% in the company. So where $1 million buys 20% of equity at a $5 million valuation for the company, that same $1 million buys only 10% of tokens, which implies a network valuation of double that of the company, or 10 million. And to make that even more clear, let's see what happens to network valuation when founders decide they're going to give 75% of network tokens to the community. So as you can see here, now the core team and early investors would again be cut in half. The same $1 million that bought 20% of the company is now only buying 5% of the tokens, because the community has the other 75%. So hopefully you can see and build an intuition now that the valuation for the network is dependent upon the amount of dilution penciled in for the community, which again is a function of the total supply of tokens and how they get distributed over time. So given that, you probably can tell that the future token distribution to community members is closely related to ownership dilution for the core team and early investors. And accordingly, it's really important to have a good plan for how that token distribution to the community is going to work and who the stakeholders are. So a few key takeaways to note about deal structure. First is that equity with rights for tokens is a great way to align founders and investors for the long term that it takes to build a product, build a community, and eventually turn ownership over to that community via tokens. And again, this structure, it adds a lot of flexibility to founders to figure out the best way to achieve product market fit without mandating that they necessarily produce a token to do it. And a keystone of this structure is that token rights give founders and investors alignment on some dilution planned for the community. But by giving community members that stake in the network, early founders and investors are leveraging this new tool for community growth and network effects that traditional startups haven't really played with to date. And so that's a really exciting new tool, but it's important to plan what that token distribution looks like in advance so that both founders and investors know what their respective ownership stakes in the networks are going to be in the long run. And finally, the last takeaway, it's what I just said. It's that token distribution should be considered upfront in order to reason about the team and investors' long-term ownership stake. And I guess it's good that I'm reiterating that a second time because that's a crucial point when it comes to fundraising. So let's dig in on that a little bit more. And this brings up the topic of network monetary policy. So there's no one-size-fits-all monetary policy in crypto networks that dictates what the supply of tokens or ownership stakes will be. This is all very dependent on the type of network that you're launching, the various stakeholders involved, and how you incentivize them to contribute. But we can talk about a few examples. So, of course, the most famous is Bitcoin, where the code specifies that there will only be ever 21 million tokens in circulation. And those tokens are distributed each block to miners on a predefined schedule as a reward for contributing work to the network. So that's a very simple monetary policy, and it's easy to reason about one's ownership stake in the network because there's a predefined number of tokens. But other networks, such as Ethereum, they don't have a fixed supply and instead have a perpetually inflating monetary supply, policy or token supply. So tokens in Ethereum are continually minted to reward ongoing active participation of the miners in the network. And so in the case of a network like Ethereum, if token supply is always growing, then it seems as though founders and investors would be perpetually diluted, losing ownership over time. Now, in the case of Ethereum, that is actually true. But in other networks, that's not always the case. So some networks have perpetual inflation that can actually be productive in the sense that capital assets in the network or tokens in that network can be put to productive use by staking. So let's look at that. So in proof of stake networks like Celo or Forte, token owners can actually stake their assets as a bond that secures the work that they do to keep the network operational. If they do a bad job, those tokens can get programmatically taken away. That's proof of stake. And This means that an investor or token owner can stake their tokens in a network in order to make them productive. And when multiple investors and token owners do this, the result is a live functioning decentralized network. So token owners become the network operators, and in exchange for their work, the network mints new tokens and rewards them. So here is inflation, and it may be perpetual, but it's non-dilutive, since those that are making their tokens productive in the network are able to earn those inflationary rewards, increasing the number of tokens that they own while the supply of tokens continues to inflate. So here, their ownership stays the same so long as they participate. And this is why raising capital from those native to the crypto ecosystem can be really advantageous to founders, because number one, they understand that community ownership and operation is critical to the success of these networks. And with an effective network monetary policy, these investors are highly incentivized to become active community members in order to maintain their ownership stake in the network and increase their returns as the service grows. So with that kind of specialization in mind, I think want to wrap up with a look at the different sources for capital in the ecosystem and how they compare. So yeah, there's been a bit of an evolution of financial capital available to crypto startups. Crowdfunding was the most popular way for crypto startups to raise funding from 2014 to 2017-18 or so. And during that period, we saw many of the top 10 crowdfunding events in history play out as ICOs. And that's probably because the ability to distribute packets of value in the form of tokens made investing in new startups as fast and as easy as sending an email. And that's just never been the case before. And while crowdfunding can be a great way to build a community, we know from Brian's talk that it comes with a host of regulatory considerations. And dealing with those issues and the complexity of managing a large liquid token distribution can be a distraction from managing product development and achieving product market fit. So it's super important to weigh the trade-offs of raising money from the crowd versus focusing on building a product. But the crowdfunding model is still one that is exciting, and the membership model that Brian Brooks talked about is a possible path forward for that, that we look forward to seeing more information on soon. Around the same time that the ICO boom hit its peak, we started to see the emergence of another form of capital available to crypto startups, and that was coming from crypto hedge funds. So a number of hedge funds got raised, and typically hedge funds focus on trading liquid assets. And that's because their investors, the investors in hedge funds, typically are focused on short-term returns that you get from trading. And that's manifest in the lockup period for capital invested in hedge funds, which tends to range from monthly to quarterly or sometimes yearly redemptions. So this shorter time horizon can lead to some sort of unstable alignment between core teams and hedge funds, in that it takes time to build a product and a community and ultimately to exit to that community. And investors who are focused on short-term returns, short-term trading, may not be able to or willing to stick around through volatile markets and all the time that it takes to bring the product to fruition. And so finally, that gave rise to another form of capital for crypto networks, and that is crypto-focused VC. And like traditional VC, crypto VCs tend to have committed capital, which means their investors are locked up for 10 years or thereabouts. So with that capital committed over the long term, crypto VCs are much more capable of being aligned with founders for however long it takes to build and launch a network and ultimately turn it over to the community to own. And further, specialization goes a long way to figuring out, the appropriate valuation methodology, the appropriate deal structure to structure the unique sort of equity deal with token rights. And furthermore, crypto dedicated VCs have capabilities to participate in networks, custody tokens, do the sort of more technical things that crypto networks require, because as community-owned and operated networks, they depend on their early investors and community members to bootstrap the network. So specialization goes a long way, and that's something to optimize for. So with that, a few quick takeaways. Number one, it's important to understand how crypto fundraising is different from traditional startup fundraising. North Star is to exit to the community by giving the community ownership and inviting their active participation in operating and growing the network. And so it's important to have a really clear plan for transitioning the community to that ownership and participation model. And we think that raising equity with an option for tokens is the best structure for aligning founders and investors early on through this journey of progressively decentralizing the product or service to a community-owned network. And finally, your early community, including investors, play a crucial role in achieving this. And so you need to make sure, as you're going and thinking about fundraising, how do you optimize your fundraise for a community that is long-term aligned? And so with that, I'm going to open it up to Q&A, and Ali, I think, is graciously going to help me moderate the questions so I can focus on answering them. So Ali, if you're out there, shoot those questions over.
Awesome. Thank you, Jesse.
Cool. Well, the first question here is from James, and it reads as follows. So let's say that a company builds a great product and a strong community, and then successfully launches a decentralized network powered by a token. Can you talk about what things look like for that original company afterwards? Who should be responsible for the mobile app that was the original product if mobile apps cannot be maintained in a decentralized way? Should this be operated by a new company? And if so, what should the funding and business model look like for that company?
Yeah, that's a really good set of questions. So yeah, there's the way that I think about it is, the company that launches the network has, maybe let's say they built full stack, as in James' example, and I think Compound is a really good example of this, where they both built a smart contract and they built the first user interface, which could be the mobile app in James' example. Once the network is live and running, hopefully it becomes decentralized through multiple community members contributing to it and building on top of it. And in that scenario, the mobile app that they've built is just one of N, or one of many mobile apps sitting on top of this network or smart contract. And so the business model for the company and the business model for the network start to diverge here, right? There's hopefully a business model at the network level, which could be maybe a fee taken in a marketplace. And then there's also a business model at the application layer, and that could be different. That could be an additional fee on top of that charged by the smart contract. It could be advertising. It could be anything. And so that divergence in monetization is a big deal, and it's something that founders of the company need to consider. Which one do they want to prioritize? It may be the case that just by virtue of owning some tokens in the network, that company is sustainable as it sees fees coming out of the network and hopefully growth in those fees as more community members contribute to it. So that could be one viable model for the company and its investors, is to just focus on making the tokens more valuable by, say, empowering third-party developers. And then once that's the case, they could also build out a product team on top that implements this other business model at the client level.
Fantastic. So the next question here is from Paul. What is your best guess for how soon we'll have a norm for the right community ownership fraction? Do you imagine that once that stabilizes, then that norm will persist, just like how the 4-year vesting schedule became so standardized in traditional startups?
Yeah, it's a great question. I think it's going to be highly dependent on the network and its application. So for something like Bitcoin, which aims to be a sort of non-sovereign store of value, I think it's really important that it's extremely community owned, right? Meaning the most decentralized ownership you can imagine, because that gives it the trust guarantees that for an application like non-sovereign store of value, that make it valuable in the first place. But other networks that are sort of maybe less paranoid about decentralization and just want to meritocratically reward folks for contribution, you could imagine a very different distribution. Maybe one that more fairly reflects the degree to which community members are contributing over time versus the value that the core team has created at the outset. So I don't think, to answer the question directly, I don't think there is yet a precedent set for this, but certainly I think it will emerge over time, and it'll likely be standardized relative to the type of application or network in question.
Yeah, and it's likely to also depend on the specific monetary policy that the network has and the amount of inflation that it has over time.
Right.
It's hard to have a single kind of one size fits all solution up front.
Yeah, exactly. You really need to consider who are all the stakeholders, what is the value of their contribution, and how does it play out over time, and design the network's monetary policy to best reward those efforts.
The next question is from both Stefan and Paul. How should founders think about a network's concentration and how it impacts decentralization versus ability to fundraise? And how can founders protect themselves and the retail community against aggressive token sales from investors that could hurt the credibility of the space in the long term?
Well, I think Brian Brooks' model that he proposed earlier, I think, is a really interesting thing to bring up again here. I think it points to a way to conduct a crowd sale that really aligns all the participants in this network, or in a network, I should say, in a really useful way. So you do benefit from. Speculation is a powerful tool. People wanting to profit is a powerful incentive to get a network going. And so, but you want to do it in a sort of responsible way. And I think, limiting membership to those folks that are, defined in a useful way, people who can actually participate or contribute. That's one way to mitigate some of the risks that we saw in sort of the Wild West of ICO crowdfunding. So I'm excited about that. I think that answers the second part of the question. The first part, remind me again.
It's about the problem that concentration in the network poses. The question of decentralization. If it's very centralized, does that hurt the credibility of the space? Does that also impact the ability to fundraise? There's a trade-off between centralization and fundraising.
That's right. Yeah. So yeah, I think there is a trade-off. Whether it hurts the project or not, I think, again, depends on the application in question. So it may not be the case that all projects need to be extremely decentralized. It could be that some startups in the space tend to have stronger leadership and maybe are sort of more product focused and lead those products as such, but then have a vibrant community of contributors that get some ownership but not all, right? And that could be an acceptable way to operate one of these networks, so long as you're very transparent about that. But then others that require high degrees of trust, they will require much more decentralization in order for all the participants to feel as if they have control, they have a say, and there's not some overarching oligopoly that will topple their interests. So again, I think it really depends on the application, but decentralization maximalism, I think, is useful for a certain class of applications, but maybe not for all.
And along these same lines, what are your thoughts on things like lockups and airdrops as a way of managing a community and ensuring that they stay aligned over the long term?
Yeah, so I think lockups are a great tool, very common in startup equity. You vest your tokens over time. Often it's the case that when a company goes public and equity gets liquid, employees are locked up and investors are locked up, and that's useful because it means those with insider information into how the product or service works aren't able to dump those equities or tokens in the case of crypto networks on unknowing investors who are just sort of finding out information from the company day one. So yeah, I think lockups can be a very powerful tool. Investing can be a powerful tool that we take from the equity world into the token world. And there's new ways to do it, which are interesting. Like the perpetual inflation is a great way to keep contributors active over time, right? So if you don't participate in a network, and you just let your tokens sit there and the network is perpetually inflating, you get diluted. So that's sort of a similar way of achieving the same ends of keeping people committed to the network. And so there's some new ways to explore this concept of lockups that have a similar effect.
What about airdrops?
Yeah, airdrops. Well, I think airdrops are an effective way to make the transition from traditional product team and startup to community ownership, and especially so once you have users actually using the product or service, because at the point that you have usage and to analyze, you can really start to think about who's contributing value and then reward them through an airdrop. So that's a pretty powerful tool. And in my talk on progressive decentralization, I sort of discuss the idea that you could do so in sort of a promissory way. So, for example, running a testnet program where you tell folks, hey, if you participate in the network early and run this testnet, when the main network goes live, you'll receive some tokens in the Genesis block, which is similar to an airdrop. So I think that can be a really effective way to sort of make the transition to community ownership.
The next question is from Stefan. How important is fork protection or defensibility to fundraising?
Yeah, it's a good question. Well, so this goes back to the talk that you gave on business models and also the one that I gave on progressive decentralization. And I think what defensibility comes down to in crypto is network effects and switching costs. And so where there are strong network effects, whether around liquidity, for example, or security, there are switching costs, and those switching costs allow for networks to extract some margin of defensibility. Now, it may be less than the margin that traditional startups are able to take because their code is proprietary and crypto code is open source, but it's non-zero. Now, so that's to say that defensibility is important when considering fundraising, and it'll be important to investors to assess the project on the merits of how defensible it is. But defensibility does exist in crypto networks, and so to the extent that you've thought about it and designed for it, it should be possible to communicate that to investors and raise funding accordingly.
Yeah, absolutely. And I think it's important to know what exactly we mean here by fork protection, because you could interpret that in two ways. You could imagine that fork protection means making your code base proprietary or something like that, and then that would have the kind of the negative result of that would be that you would have a smaller community because people are less likely to believe in a platform that's not really open and is not inclusive. Whereas what you're talking about now is fork protection that comes from network effects and from the switching costs that emerge as a result. That's kind of fork protection that you would want to go. And I think that kind of the fundraising question hinges on whether a network has the potential to be massive and to include a very large community so as to become a fundamental kind of primitive that people build on top of.
Totally. Agreed.
So the next question is from Abhishek. I'm hoping I'm pronouncing that correctly. Do you see room or have a structure for multiple classes of tokens for the investors, founders, and community that distinguish their role in keeping the community and network alive?
Yeah, it's a good question. So there, in traditional startups, there are different classes of equity. There's common stock and there's preferred stock, and they have different rights. In crypto, I don't think I've seen a network that has that distinction. It's usually the case that that most tokens are equal, but that's not to say that it's not possible to do otherwise, right? You could imagine assigning certain logic to certain subsets of tokens, and like, for example, just sort of thinking out loud, through a process of delegation, you could imagine that a community votes to say, hey, this address and their tokens count for double in a voting scheme, for example. So I think you can program any kind of classifications that you want, and that's something interesting to experiment with. but I haven't seen much of that. Most tokens in the networks I've looked at are sort of the same or fungible, and there's advantages to that. Of course, there's non-fungible tokens for unique digital items, and that's a whole nother thing. But yeah, I think it's an interesting idea to explore networks with different with hierarchy and structure, that you can get an equity, but here in crypto, you'd program it as code.
Maybe a good example might be Compound, where you have seed tokens. There's a specific seed token for every trading pair, or for every asset that you might kind of lend out to the platform. And then there's a separate governance token for the whole platform. And so those two are kind of very different, and that one is kind of global for the whole network. And then the seed tokens are specific to the liquidity providers for each of the specific assets.
Yeah.
And so maybe that's an example, but I think you're right that it's probably underexplored, and there's a lot that can be done, and it's kind of sky's the limit given that it's all fully programmable.
Right. Yeah, the compound example is a good one. Also, Maker has DAI and it has MKR. So yeah, these are not different classes of stock or tokens, but they're two distinct tokens that sort of are the product of the same network.
Right. So there's one more question, and this one is from Tina, and it reads, raising human capital versus raising monetary capital. Is it possible to design a continuous Flash organization for quote unquote side gigs that first raises human capital via a mutuals model and only later raises monetary capital from funds to scale after proving product market fit?
Okay, so the way I'm interpreting this question is like there's human capital, which I would sort of classify as a subset of production capital, and there's the financial capital, which is just money that maybe buys that human capital. I think this goes back to what I was saying earlier, where in crypto networks, part of the production capital of the network comes not just by hiring employees to a company, but from the community actually contributing resources themselves. And so that could be in the form of human capital. It could be, for example, community building, or marketing, or or code. Right? That's all the product of human work. And so that's part of the production capital that community members contribute to crypto networks. And so yeah, I think it's very much the case that human capital has a role to play in crypto networks, and it's part of the production capital that they're comprised of.
Yeah, absolutely. Well, that's our last question.
Okay, sweet. All right. Well, thank you guys.